There's a moment in 1980 when two brothers from Texas nearly broke the global financial system. Not through fraud, not through hacking, through buying. The Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, oil billionaires who decided to corner the silver market. In 1979, silver was trading at $6 per ounce. By January 1980, it hit $50 per ounce, an 800% increase in 1 year. And the Hunt brothers owned 1/3 of the world's deliverable silver supply, 200 million ounces, worth $4.5 billion. That's $17 billion today. They weren't breaking laws. They were using the free market, buying silver, taking physical delivery, holding it, watching the price rise. Legal capitalism. But when the price hit $50, the system panicked because the Hunt brothers had borrowed billions from banks using silver as collateral. If silver crashed, the Hunts couldn't repay, and the banks would collapse. So on January 21st, 1980, the exchanges changed the rules. Mid-game, Silver Rule 7. No new long positions allowed. You could only sell silver, not buy. Silver crashed from $50 to $10.80 in 2 months, a 78% collapse. And on March 27, 1980, Silver Thursday, the Hunt brothers defaulted. The Federal Reserve organized a $1.1 billion bailout, not for the Hunts, for the banks. But here's what they don't teach you. The Hunt brothers weren't the villains. They were players who got too good at the game. And when outsiders start winning, the system changes the rules. Every market corner begins the same way. Quiet accumulation before anyone notices. The Hunt brothers started buying silver in 1973, not in futures markets, in physical metal. They bought, took delivery, and stored it in vaults across Switzerland, New York, and London. By 1974, they owned 55 million ounces. By 1979, over 100 million ounces. By early 1980, 200 million ounces, 1/3 of the world's deliverable supply. Why silver? The Hunts believed inflation was coming. Nixon had closed the gold window in 1971. Fiat currency, unlimited printing. They thought hard assets would protect wealth. They were right. Between 1973 and 1980, inflation averaged 9% annually. Gold went from $35 to $850 per ounce. Silver went from $2 to $50 per ounce. But the Hunts didn't just buy and hold, they engineered a corner. They bought silver futures on COMEX, contracts to buy silver at future dates. But instead of settling in cash, as most traders do, they demanded physical delivery. This forced sellers to actually deliver metal, and there wasn't enough physical silver to deliver. So the shorts had two choices: find silver and deliver it, or buy back their contracts at whatever price the Hunts demanded. This is a squeeze, and it's legal. As delivery dates approached, shorts panicked. They had to buy silver to deliver, which pushed prices higher, allowing the Hunts to borrow more against their rising holdings to buy more silver, which pushed prices higher. A feedback loop. That's stage 1. When the corner is built quietly, before regulators notice, before anyone realizes what's happening. Stage 2 is when accumulation becomes a squeeze. When shorts realize they're trapped. When the price goes vertical. In January 1979, silver was $6 per ounce. By September 1979, $16. By December 1979, $28. By January 1980, $50. An 800% increase in 1 year. The Hunt brothers' holdings went from $1.2 billion to $4.5 billion in 12 months. And the financial world panicked. This wasn't just a price increase, this was a corner. The Hunts controlled the supply and they weren't selling. Short sellers who had bet silver would fall were trapped. They owed silver they didn't have, and the Hunt brothers owned it. So the shorts had to buy at any price from the Hunts. Control supply, force demand, extract maximum price. But the Hunts had another advantage: leverage. They'd borrowed billions from banks using silver as collateral. As prices rose, their collateral became more valuable, which allowed them to borrow more to buy more silver. By early 1980, the Hunts had $4.5 billion in silver holdings and $3 billion in borrowed money. Leverage ratio, 2.5 to 1. And the banks lending to them were Chase Manhattan, Citibank, manufacturers Hanover, and Bosch Halsey Stewart Shields. The biggest names on Wall Street, all exposed to the Hunt brothers, all vulnerable if silver fell. By January 1980, the system realized the problem. If the Hunts kept buying, silver could go to $100, $200, maybe higher. Industries that used silver, such as photography, electronics, and jewelry, would be destroyed. Or if silver crashed, the Hunts would default, and the banks would collapse. Either way, the system was at risk, and the system decided the Hunt brothers had to be stopped. That's stage 2. When the squeeze forces prices upward, the system recognizes that outsiders are winning. Stage 3 is when the public notices, when mania sets in, when everyone wants a piece. By late 1979, silver was front-page news. People were lining up at coin shops, melting down silverware and selling jewelry, anything to profit from $50 silver. Tiffany and Company took out full-page ads in the New York Times attacking the Hunt brothers. We think it is unconscionable for anyone to hoard several billion worth of silver, and thus drive the price up so high that others must pay artificially high prices for articles made of silver. A major company publicly attacking private citizens for buying a commodity. Unprecedented. But Tiffany's was suffering. Silver prices were so high that jewelry was unaffordable. Their business was collapsing, and they blamed the Hunts. The media loved it. Texas oil billionaires corner silver market. Hunt brothers manipulate prices. Silver shortage caused by hoarding. But here's the question. Nobody asked. What law were the Hunts breaking? They bought silver, took delivery, and held it. This is legal. If you buy gold and hold it, that's investing. If you buy real estate and hold it, that's investing. Why is silver different? Because the Hunts were too good at it. They'd cornered the market, and corners are legal until they're not. By January 1980, pressure on regulators was immense. Congress held hearings. The CFTC investigated. The exchanges demanded action because the Hunt brothers weren't just winning, they were exposing the system's fragility. The entire financial system was built on leverage, on the assumption that not everyone would demand delivery, that futures contracts would settle in cash, that physical commodities were just abstract numbers on a screen. The Hunts demanded physical metal, and there wasn't enough. The system's bluff had been called, and the system doesn't like being called. That's stage 3. When mania peaks, media attention explodes, and regulators are forced to act because the system can't allow outsiders to win at this scale. So on January 21, 1980, the rules changed. Stage 4 is when the system protects itself. When rules change mid-game, when free markets become managed markets. On January 21, 1980, COMEX and CBOT issued Silver Rule 7. Immediate effect. No new long positions in silver futures. You could only liquidate existing positions. You could sell. You could not buy. The Hunt brothers could no longer accumulate. But short sellers could still sell. Asymmetric. One side could act, the other could not. The justification, orderly markets, preventing manipulation, protecting market integrity. But here's what really happened. The exchanges protected the banks. The banks had lent billions to the Hunts. If silver kept rising, the Hunts would profit, and banks would be fine. If silver crashed, the Hunts would default, and banks would collapse. Silver Rule 7 didn't prevent manipulation. It was the manipulation. It tilted the playing field against the Hunts in favor of the shorts, and the price responded immediately. January 21st, $50 per ounce. February 14th, $36. March 14th, $21. March 27th, $10.80. A 78% crash in 2 months. Not because of market fundamentals, because buying was banned and only selling was allowed. When only one side can act, the outcome is predetermined. The Hunt brothers sued. They argued that the rule change was illegal, that it violated their contracts, and that exchanges can't just change the rules mid-trade. They lost because the system protects itself, always. By late March 1980, the Hunts were in crisis. Silver was crashing, their collateral was evaporating, and banks were demanding payment. The margin calls were coming, and everything the Hunts had was in silver. That's stage 4. When regulators intervene, exchanges rewrite rules, and free markets reveal they're only free for insiders. Stage 5 is the endgame. When the corner collapses, the system survives, and the outsiders lose everything. March 27, 1980, Silver Thursday. The Hunt brothers received a margin call, $135 million due immediately. They didn't have it. All their wealth was in silver, and silver had crashed 78%. They defaulted, and the panic spread. The Hunt brothers owed $1.7 billion to Bosch, $800 million to manufacturers Hanover, $500 million to Chase Manhattan, and billions more to Citibank, Engelhard, and others. If the Hunts couldn't pay, the banks would absorb massive losses, possibly collapse. And if the banks collapsed, the system would freeze, just like 2008, but in 1980. So the Federal Reserve acted. On March 28th, Paul Volcker, Fed chairman, organized a bailout, not for the Hunts, for the banks. A consortium of banks provided $1.1 billion in emergency loans to keep the Hunt brothers' creditors afloat, to prevent systemic collapse. The Hunts lost almost everything. Their silver holdings were liquidated. Their oil assets were sold. Their wealth evaporated. But the banks survived because the Federal Reserve intervened. This is the pattern. Outsiders take risks. The system allows it until the outsiders win too much. Then the rules change, the outsiders collapse, and the banks get bailed out. The Hunt brothers filed for bankruptcy in 1988. Nelson Bunker Hunt, once worth over $8 billion, died in 2014 with a fraction of that wealth. The lesson? Markets are free until they're not. Rules are fixed until they're changed, and the system protects insiders. Always. You can win in the market as long as you're not winning too much or winning against the wrong people. Because when you do, the rules will change and you'll be left holding nothing. That's stage 5. When outsiders lose, banks survive, and bailouts protect the system. The Hunt brothers pattern just repeated. January 2021, GameStop. Stage 1, the accumulation. In late 2020, retail traders on r/Wall Street Bets noticed GameStop was heavily shorted. 140% of available shares were shorted. Hedge funds had borrowed more shares than existed to bet GameStop would fail. Retail traders started buying quietly, accumulating shares, just like the Hunts accumulated silver. Stage 2, the squeeze. January 2021, GameStop went vertical. $20 on January 12th, $40 on January 19th, $147 on January 25th, $483 on January 28th. A 2,400% increase in 2 weeks. Hedge funds were trapped short, had to buy shares to close positions, but retail traders owned them and wouldn't sell. An infinity squeeze forming, just like the Hunt brothers' silver squeeze. Stage 3, the mania. Media coverage exploded. Reddit traders versus Wall Street. David versus Goliath. Millions of new traders joined Robinhood to buy GameStop. Public mania, just like silver in 1979. Stage 4, the rule change. January 28th, 2021, 9 a.m. Eastern. Robinhood restricted GameStop buying. You could only sell, not buy, exactly like Silver Rule 7. The justification? Protecting investors, managing risk. But the reality is that Robinhood's clearinghouse demanded $3 billion in collateral. Robinhood didn't have it, so they halted buying to protect themselves, not investors. The price collapsed. $483 in early trading, $193 by market close, $90 by February 4th, $40 by February 19th. A 92% crash because buying was banned. Stage 5, the collapse. Retail traders lost billions. But hedge funds? Melvin Capital got $2.75 billion from Citadel and $0.72 to stay afloat, a bailout. Just like the Hunt brothers banks, the pattern is identical. Hunt 1980, buy silver, price rises, mania, COMEX bans buying, crash, Fed bails out banks, GME 2021, buy stock, price rises, mania, Robinhood bans buying, crash, hedge funds get capital. Same playbook, same outcome, 41 years apart, and in 2022, it happened again. A Chinese trader cornered nickel on the London Metal Exchange. Price spiked 250% in hours. LME canceled $4 billion in trades retroactively, trades that had already settled, unwound to save insiders. The pattern never changes. Only the commodity, silver, stocks, nickel. Same 5 stages, same rule changes, same protection of institutions, same punishment of outsiders. If you've watched this far, you understand the market corner cycle. You see how the Hunt brothers in 1980 and GameStop traders in 2021 followed the exact same 5 stages. Subscribe to Capital Origins, because when the next market corner forms, when the next group of outsiders starts winning, you'll want to know which stage you're in. And when the rule change is coming, markets are free until they're not. Rules are fixed until they change. Hit subscribe. Because the Hunt brothers story happened over 4 decades ago, but the pattern repeated just a few years ago, and it will repeat again. You just need to recognize it before stage 4, before the rules change, and before you're holding the bag.